Good evening, everyone. A warm welcome to all of you. I am CS Nigda Nigam, and it's my privilege to be your moderator for today's webinar. We are thrilled to have you join us for the Know Your Law series number 95 webinar on FEMA, background, ODI, and form filings, organized by Committee on Commercial Laws, Economic Advisory, and NPO Cooperatives of the Institute of Chartered Accountants of India. This session promises to be an insightful journey into the world of FEMA. Before we dive in, let's take a moment to introduce our Committee on Committee on Commercial Law, Economic Advisory, and NPO Cooperative. The driving force behind this webinar, the committee is dedicated to empowering chartered accountants to shape strategies and policies that unlock economic, financial, and social value. It combines analytical foresights with commercial acumen, equipping CAs to lead in a dynamic global landscape. The committee's mission spans multiple fronts, providing in-depth analysis, disseminating knowledge, offering inputs to regulators for policy formation, and developing technical guidance and background materials. Above all, it aims to create awareness about the vast professional opportunities for CAs in areas like commercial laws, economic advisory, and NPO cooperatives. Today's webinar is a testament to that commitment, bringing you practical insights to navigate famous complexity with confidence. In just a few minutes, we'll start with our eminent speaker who will unveil the intricacies of famous background, overseas direct investment, and firm filings. Whether you are advising clients on global ventures or ensuring compliance, their expertise will equip you with actionable tools to excel in your practice. As we start our webinar, I am delighted to introduce our esteemed speaker, CA Amar Goawala, whose insights will light the way through famous complexities. CA Amar Goawala is a fellow chartered accountant of ICI, having qualified in 2013 and brings over 11 years of rich professional experience to the table. As a partner at Messrs. GKTJ and Associates, he has honed his expertise in navigating intricate regulatory landscape with a special focus on the Foreign Exchange Management Act. A passionate educator, C. Amar serves as faculty member of ICI's prestigious famous certification course, empowering professionals with practical knowledge. He is also part of the team crafting two upcoming FEMA publications, showcasing his deep commitment to advancing the field. Today, he'll guide us through FEMA's background, overseas direct investment, and firm filings, offering tools to master compliances and seize global opportunities. Please join me in giving a warm virtual welcome to CA Amar Goawala. Over to you, sir.
Thank you, ma'am, for your kind introduction. Thank you, the committee, for inviting me for this webinar. To my colleagues, a very good evening. Just allow me a minute to share my PPT. So today, let's discuss how the Foreign Exchange Management Act was formulated, the background and the history behind it. Also, we shall be discussing about the overseas direct investments, the specific rules, regulations, and directions with respect to the same, and the various form filings in with respect to FEMA. There are various form filings. Some are online, some are offline. So we'll be discussing with about them in detail. So exchange control was always there, and it was brought in by the Britishers in 1939. Post-independence, India, it had just got independent. It was a new country. There were significant economic challenges. It had to manage its foreign exchange reserves, which was crucial for managing the balance of payments. And that was for that reason, the Foreign Exchange Regulation Act 1947 was enacted. Also, the World War II had just got over in 1945. In 1947, the World War II got over, and that had also disrupted the economy and trade, and so there was a lot of disruption of trade in the global market also. So the main aim of the Foreign Exchange Regulation Act 1947 was to regulate the payments and dealings in foreign exchange as well as conserve the foreign exchange. FERA 1947, it was less stringent and it was focused more on managing foreign exchange to a regulatory framework rather than to strict enforcement. Over the years, as India's economic challenges evolved, there was calls to strengthen this act. Hence, it led to an introduction of a more comprehensive and the stringent version of the 1973, which we all know. So, FERA 1973 came into effect on 1st January 1974. It was mainly formulated to deal with the deep crunch of foreign exchange in the economy. Now, you have to understand the situation of the country. There was a balance of payment crisis. Now, what is balance of payment? Each country needs to have a certain foreign exchange reserves in order to make its overseas payments. And we are now hearing in the news, overall in the news, about the President Donald Trump, about the tariffs being introduced by USA and how all the countries are being affected by it, because there's a lot of internal trade and there are a lot of foreign loans which each country takes from each other. So, uh, in during those times, India had a balance of payment crisis and uh, and the government had to mortgage a lot of its gold to make its import payments and to make its loan payments, and there was some strict law which was required to be gotten, and that strict laws which had to be gotten the and that was through the privatization, liberalization and globalization of the economy. There were various economic reforms undertaken by the then government. A new industrial policy of 1991 was formulated, and various reforms were done, and under various sectors. Some were under the industrial sectors, some were in the foreign exchange sector, some were in the finance sectors. So we'll just be discussing the other sectors in small, and then we will be discussing about the foreign exchange regulation. So earlier, there was a lot of industrial licensing, and in due course, this industrial licensing was abolished for all except for 18 sensitive industries like alcohol, cigarettes, hazardous chemicals, drugs, explosives, etc. Many industries which were reserved for public sector were now de-reserved. Only industries like railways, defense equipment, atomic power generation, etc. were reserved for the public sector. Then there were various financial sector reforms. These financial sector reforms reduced the role of RBI from the regulator to facilitator for the financial sector. It led to the privatization of the banks. Now we all know the RBI granted licenses to several private entities to set up banks like HDFC, ICICI Bank, IDBI, UTI, IndusInd Bank, etc. Now, with the entry of these private banks, there had to be a strong regulatory network, and RBI was entrusted with strengthening this regulatory framework. They introduced various regulations with respect to capital adequacy and asset classification. Capital adequacy norms basically is each bank has to keep a minimum amount of capital for a need of payments. And asset classification standards, we all know all banks have to classify their assets as standard, non-performing, loss-making. So they had to be with the best industrial practices. Corporate tax was very high and it was quite complex that time. There were even 11 tax slabs at one point of time. The tax rate had even gone up to 97%. So this tax rate eventually was simplified and reduced. Then comes the most important foreign exchange reforms. So the Foreign Exchange Management Act 1999 came into play. It came into effect from 1st June 2000. It was enacted in December 1999 and it came into play on 1st June 2000. It replaced the earlier Foreign Exchange Regulation Act of 1973. Now, this FEMA Foreign Exchange Management Act is more liberal and it aims at facilitating external trade and payments. Its main aim is to promote the orderly development and maintenance of foreign exchange markets in India. The RBI adopted a more proactive approach to managing India's foreign exchange reserves, which were critical for managing the economic stability. These reforms have now led to a good amount of increase in the foreign exchange reserves, which are being held by the country. So as I said, there was a post-liberalization and new industrial policy of 1991, which the government enacted. Now to remove, now they got the policy of, they framed new policies. However, they had to remove the shackles of regulatory and legal provisions. They had to make this policy meaningful and workable. Hence, FEMA introduced a healthy environment of acceptability and opening India to the world. The powers and authorities were delegated. RBI and central government were given specific powers and responsibilities. So the change in economic scenario brought about globalization of capital, free trade across the globe, and it necessitated the need for managing foreign exchange in a country in an orderly manner. So the main aim of FEMA was to establish a system to manage India's foreign exchange and develop clear policies and rules to control and develop the foreign exchange market. With the help of FEMA, I've just brought in some statistics. The foreign exchange reserves of India were around 27 billion US dollars in 1998, and it now risen to 650 billion US dollars as on May 2024. So FERA, from FERA to FEMA, India transited from an era of regulation, control, and prohibition to a new era of consolidation and management of foreign reserves. So just a small summary and differentiation between FERA and FEMA. So Foreign Exchange Regulation Act was enacted in 1973, the second one. The FEMA was enacted in 1999. The main aim of FERA was to control, conserve, and regulate foreign exchange, while the main aim of FEMA is to manage and facilitate foreign exchange. In FERA, the main assumption was the foreign exchange is a scarce resource and it hence must be protected and used with great care. While in FEMA, it is foreign exchange is an asset and it has to be properly managed and facilitated. In FERA, there were strict penalties and criminal charges were for violations. Even the Enforcement Directorate were entrusted with a lot of authorities in with this particular FERA. Well, on FEMA, the emphasis is basically on compliance and civil penalties. In FERA, basically everything was prohibited, and FEMA, basically everything is allowed except prohibited. FERA, basically the main violations were criminal offense, while in FEMA, the main violations are civil offense. So FERA was restrictive in nature and it aimed at protecting the Indian economy, while FEMA has a more liberal approach and it encourages foreign investment and trade. FERA brought in a lot of stringent controls on foreign exchange transactions. Licenses and approvals were required for various activities. While in FEMA, it simplified the procedures. It puts few restrictions and it emphasizes on reporting and compliances. So FERA was also complex. There were around 81 different complex provisions. While in FEMA, there are only 49 simple sections. So let's understand how FEMA has helped the economy and the business. As we all know now, business, the main aim the main aim of the government was to open up the economy, and one important was the liberalization of the economy. It brought in huge FDIs into India. It removed all the obstacles with respect to foreign investments. Now, when Indian industries start getting FDI, they have more money, they have more capital, which leads to more business and more employment generation. Further, in Indian business now has a choice either to get money from borrowings or through the FDI route. Now, in borrowings, there's always the problem and the restriction of the interest, which when you have an FDI, yes, you have to give a share of your profits, but there's not that constant payment of interest and the constant repayment fear. When you have an FDI, if it's a profit, you'll distribute the profit. It's business. So and not only FDI, with respect to the FEMA, India, it allowed businesses to make overseas direct investments abroad. Indian entities can now compete globally among the market. And if you see in real time, in today's time, there are a lot of businessmen who are investing abroad, who are setting up subsidiaries abroad, and are expanding and globalizing their business. So it has helped India to compete with the global market. Just again, some statistics. As per the Economic Times, India's forex reserves rose to an all-time high of 648.7 billion US dollar as of 17 May 2024, and it covered 11.4 months of imports, which strengthens our buffer against the foreign exchange payments. Now, friends, there's a huge practice opportunity for us chartered accountants in FEMA. See, with respect to Companies Act, with respect to statutory audit, with statutory audits, and with respect to Income Tax Act. Now we, as chartered accountants, have quite good amount of control and knowledge about it. But with respect to FEMA, there is still very few consultants in the market. Also, the businessmen, when they want to make a foreign exchange transactions, they prefer to go into consultant who have some specialization with respect to FEMA, because they are also fearing penalties with respect to the foreign exchange transactions. And when an Indian industry is dealing with a foreign company, so he has to get the transactions perfect. Hence, they require skilled consultants who can execute the work proper. And friends, even if we are not practicing in now in with respect to FEMA, suppose I'm a statutory auditor, and the company whose audit I'm doing, he wishes to make an overseas direct investment abroad. He will not be able to do it unless the statutory auditor gives him a certificate that all the rules and regulations with respect to FEMA have been complied. So there are a lot of certification which a chartered accountant has to do, especially a statutory auditor. So the Indian businessman will then have to go to have to go to another chartered accountant firm to do his statutory audit, who can give this certificate. And for us also, if we have to certify the ODIs with respect to the certificate, we have to have the in-depth knowledge of the ODI. Because we will be seeing the certificate in detail, it asks the question with respect to whether all the rules and regulations with respect to ODI have been followed or not. So again, what I've seen is, we as professionals, there is a little bit fear of the unknown with respect to FEMA. There is a little bit fear of what to study and from where to study. So this also we will try to take up in this seminar. We will try to understand how to download the latest act. What happens is, see, in our offices, with respect to the Companies Act or the Income Tax Act, we get the whole act, the hardbound book in our office. Every year the Finance Act comes up. Every year we have a new version of the act in front of us. So, but with respect to FEMA, normally we don't have any hardbound book. We normally don't keep the act with us. We normally go online and search for the provisions. Online, of course, on the RBI portal, all the rules, regulations, directions are available. But you have to find it, and you have to find it chronologically. Because even if you Google out, some people will say just Google it out. But when you're Googling it out and you find a rule or regulation with respect to the subject, how do you know whether this is the latest one? And from the RBI website, if you go to the RBI portal, there are a lot of different forms of data available. For example, there are rules, there are regulations, there are master directions, there are FAQs. So what to see and which to refer to, and whether whether still you are looking at the latest one, there's still a question mark among us, the professionals. So this also we will try to identify. What we'll do is, in a later part of a seminar, we will go online and on the RBI portal, and we will try to download the latest rules, regulations, at least with respect to two subjects, let's say FDI and let's say ODI. So we'll try to do that. Also, when any entity is entering into a financial transactions, there's always the fear of the ED, and there's always the fear of the RBI. So they want there is a huge demand of professionals who can execute these transactions. And businessmen, I've seen nowadays, there are a lot of FDIs which are being brought in. There are a lot of overseas investments being done by them. So we have to catch up on this opportunity to learn, to practice, and to consult our clients. Now, even if we are not, even if we are not doing a statutory audit of a company, or even if we are not in FEMA practice, there's day-to-day consultancy we can give to our existing clients also. For example, if I have a practice and I am doing the income tax returns of the individuals. Now, if that individual is a non-resident, then I can give him consultancy with respect to the bank accounts which he needs to maintain. Or suppose the non-resident then decides to come to India and settle down in India. There is some lot of procedural work has to be done. He has to change his bank accounts. He cannot keep those NRO, NRE accounts. Or I have a resident individual client who now wishes to move abroad, and he now wishes to take a job abroad for an employment, or find a business abroad. Now he will also have to surrender his resident bank accounts, and have to maintain NRE, NRO accounts. So this is all we can consult them. Further, even when we are doing statutory audits of a company who is into export business, there are limitations with respect to the limitations, rules and regulations with respect to time limit for realizing these export proceeds. So, see, we all know when we're doing a statutory audit, we have to see all type of rules and regulations. We have to see the compliance of all the laws. We refer to the Income Tax Act, we refer to the Companies Act. Also, the FEMA compliances also have to be checked. And if there are non-compliance, they may have to be reported. Even if there's an advance which has been given for purchase of goods, there is a time limit for realization of this advance or receiving by the goods. So there are rules and regulations which we have to refer to. Then if we have individuals, again, individual clients, again, there may be gifts to and from NRIs. They may have their children who are studying abroad and they wish to remit money abroad, or they may wish to remit money abroad for health and education. We all get clients who ask us with respect to the limits, with respect to the liberalized remittance scheme or the $1 million scheme. We all know any resident individual can remit foreign currency outside India with respect to current account transactions up to 250,000 USD per year. And for non-resident, it is $1 million per year. So there's a lot of consistency which we can give with respect to capital accounts, current account, which is transactions are permitted, which transactions are not permitted. So it will help us to cater to our current client base also. As I said, the practice opportunities in statutory audit, there's reporting and compliance under FEMA, which you have to check. Now, there are there are two forms which has to be filed if the Indian businessman has made an ODI abroad. A form ODI, the certification has to be done. The chartered accountant, the statutory auditor has to certify whether all the rules and regulations with respect to ODI have been complied with or not. Then once an ODI has been done, every year a form APR has to be filed. This also has to be signed and certified by the statutory auditor. So if we are not aware of the ODI rules and regulations, we will not be able to sign these. Of course, 15 CACB mostly is with respect to income tax, but it's money are going outside India. So that's why I've mentioned over here. Now, a lot of times we've seen when a client wishes to do a foreign exchange transaction done. For example, he wishes to transfer the shares. Transfer the shares of an Indian entity to a non-resident or purchase shares of an Indian entity from a non-resident. So what they ask is you as a consultant, you advise both the us and also the foreign company with respect to the documentation which has to be done. So then we have to prepare the documentation. Then we have to have meetings with the non-resident client also, the foreign client also, and we have to help them understand with respect to the documentation they will be required to be done, and what all documentation they are signing. We'll have to explain them the reasoning and what is mentioned in the documentation. Now, when we're talking about FEMA, when we're talking about FDIs, when we're talking about ODIs, of course there will be a valuation of shares. So chartered accountant do a valuation of shares. Then we don't want to go over there, but if there is any penalty, or if there is any delay in any rules and regulations, and a compounding which required to be done, or representation is required to be done in front of RBI. So who better than chartered accountants? So we can help a lot of companies who may be facing some challenges with respect to the same. Now, according to my experience, what are the points we should ensure while we are taking up the FEMA work? One is the timelines. Normally, what happens is the client instructs us, he wants to get this foreign exchange transaction done within maybe a month, within maybe a week or so. Now, you have to understand there are a lot of stakeholders in play over here. Now, RBI has given all the permission to the AD bank to approve all the forms. Any form filing which you are doing, either you are filing an FCTRS form, you are filing an ODI form, everything will be approved. All these forms will be approved by the AD bank. So when you're talking about timeliness, you also have to ensure when we are also committing to the time which will be required, we should also ensure that these will be vetted by the AD bank, and also there will be some time taken to explain or to explain or prepare a documentation with respect to the non-resident entity. Accuracy, I mean, there's no need to mention for us chartered accountants, any transaction with foreign exchange, that has to be accurate, because we are reporting to the RBI. There is forex transactions involved, so accuracy has to be a main point. Then we should have a checklist and a list of documents which will be required for each type of work. Suppose we get a work with respect to transfer of shares, or we get work with respect to FDI or ODI. We should have a checklist with respect to the documentation which will be required, which will help you to start the transaction and start the work faster. For example, you should know when the valuation report will be required. A lot of time, if there's an FDI or an FCTR is involved, the KYC of the non-resident is also required. Board resolutions are required. A lot of consent letters are required. So you should have the list of documentation ready with you, and that can be prepared and circulated as fast as possible. Now, what I advise is, see, in the end, it is the AD bank who's going to approve the transactions. So you should always send a documentation beforehand to the AD bank for the approval. AD bank will help you. Bank will help you with respect to if they find out there is some problems with the documentation or it is not as per the act, they will guide you with respect to the same. So it is always beneficial. It is always advisable to involve the AD bank beforehand, to send them the draft documents, send them the draft agreements. If the transaction is a complex transaction, it is always advisable to arrange for a meeting with the AD bank and explain to them the whole transaction. And they also should be on course with whether the transaction will be valid as per the FEMA or not. Then again, there are a lot of form filings which are required online. For example, see, with respect to ODI, it is all offline. We have to submit all these documents offline with respect to ODI. But with respect to FCTRS or with respect to FDI, with respect to Form LLP1, Form LLP2, these all forms have to be filed online. Now, then you may face some difficulties because see, once any this form filing online, we all know there may be some technical difficulties which we may face. There may be login issues, and we will discuss about the online filing forms also and the difficulties which may arise, which we will also discuss the same in detail later on. But we should always make some contingency for the time which may be required for that online filing. Again, when you file online, the AD bank will also approve online. So it will take some time. So you have to all put that contingency with respect to the time involved. How to master the subject? Of course, the main one, study the law. That's the basics. We have to study the law. The most important thing is how to refer to the law and how to know that we are referring to the right and the latest law. That also we will try to go to the RBI portal and we will try to download the latest rules regulations with respect to ODI and FDI. The institute has doing a great job. The committee on commercial laws, economic advisory, and NPO cooperative of ICI is doing a great job. They have organized a lot of seminars. They have organized a lot of certificate courses, and they have also published 2 books with respect to the FEMA, and that will help us to understand and master the subject better. Our network, of course, we have to discuss with like-minded people and try to help each other out with respect to the solutions. So now let us just come to the FEMA Act, and let's try to understand the structure of the FEMA Act. So the FEMA Act was inaugurated on December 1999, and it came into play on June 2000. It applies to all branches, offices, agencies outside India which are controlled by a person resident in India, and also to any contribution there or committed outside India by any person to whom this act applies. So if you see the basic sections, there are basically 49 sections for the Act. The Section 2 deals with the definitions. Section 3 to 9 deals with the regulation and management of foreign exchange. These are your main sections. It will deal with your dealing in foreign exchange, holding of foreign exchange, your current account transactions, capital account transactions. So these all will come under Section 3 to 9. Then Section 10 to 12 are related to authorized dealer. Section to 35 is with respect to adjudication and appeals. Section 36 to 38 is with respect to Enforcement Directorate, and Section 39 to 49 is with respect to business provisions. Now, friends, if you see the Act has 49 sections. Now, basically, the Act has given the power to the central government and the RBI to frame rules and regulation with respect to the provisions of the Act. And if you read the wording of the Act, it will be mentioned no transactions in foreign exchange can be undertaken unless it is provided by the rules and regulations and as per the rules and regulations. So your act will always refer to the rules and regulations. So your act is obviously at the top, at the prime hierarchy, and it will always be supplemented by your rules and regulations, and will always refer to the rules and regulations. So, the Section 46 of the Foreign Management Act has given the power to the central government to frame rules. Now, the rules are nothing but basically giving the powers to frame the laws. That is what the rules is. And Section 47 of the Act gives RBI the power to frame regulations. Regulations are nothing but which the procedural aspects or the procedures for how the rules have to be followed and implemented. Then, as per Section 48 of the Act, these rules and regulations have to be placed before the Parliament. Once it's approved by both the House of the Parliament, it gains legal structure. So basically, regulations are instruments by which power to make rules are basically your law, and regulations are basically the procedure for following the rules. Then there are master directions. Now, master directions are basically issued by the RBI to the AD banks, and it is for the AD banks. However, as consultants, we should also refer to the directions, because AD banks will only approve the transaction once it is as per the directions and the rules set by the RBI. So, if you read through the directions, you will find a lot of important approvals or maybe a lot of documentation which may be required to be done. So you will get to know about that. So, and one small trick is, if you want to find the latest rules and regulation with respect to any subject, try to look for the latest master directions. If you find the latest master direction with respect to the subject, this direction will always have the link and the reference of the rules and regulations. Because directions are nothing but AD bank, the RBI telling the AD bank how you have to follow these rules and regulations. So always, when you're going to the RBI portal, always look for the latest master directions. It will have the link to the latest rules and regulations, and we will see how it we will see by, I'll put the directions on screen, and we will see that. Then there are master circulars. These are nothing but consolidation of all the existing guidelines or instructions on a particular subject which has been given by the RBI. Then press notes are issued by the DPIITC. In the central government also, there are various departments which are at play, and one such important department is Department of Promotion of Industry and Internal Trade, and they release a lot of press notes with respect to which is a policy document which helps facilitating the foreign investment. Even if you see Form DI, when you're filing a form direct investment, you also have to file. See, you have to file one form at the RBI portal, at the portal by the RBI, which is you have to file at the RBI portal, and one you have to file at the DPIIT portal also. Then there are FAQs which are issued by the RBI. Now, these FAQs, if you refer to these FAQs, it will solve a lot of the questions which come to our mind with respect to FEMA. So it is always good to look at the FAQs, and it will help us understand the law better. So how to read the law? So what I'll do is I'll switch out from my PPT. I'll log into the RBI portal, and we will try to download the latest rules and regulations and the directions. Okay. Yeah. So we are at the RBI portal. My screen should be visible. Let's just check. Yeah. So my screen is visible. So I'm going in the act. Yeah. So I've searched for the Foreign Exchange Management Act, and now I'll search. Now I've just put in some key phrases which helps us to search better. So I've searched this over here. Search. What I do is, see, there's a search bar available, and I'll put it in the exact phrase. Search by the keyword with the exact phrase foreign investment in India, and search with the content of the document and update result. Now let's see. Now there is one link with respect to foreign investment in India. However, if you see, it is basically with respect to the firm's portal. So it is basically with respect to the form filings. Right now, I do not want the form filings. I want the basic rules and basic provisions of the foreign investment in India. So I'll look more. See, now I'm getting these links as per the chronological order. So this is 124. I'm getting it in the chronological order. So Again, over here, there's foreign investment in India, but it is again reporting in single master form. That I'm not looking for reporting. I want the main provisions. I go to page number 2. Yeah, these are the master directions which I was looking for. Now, if you see, these directions have been issued in 2018. However, they have been updated as on 20th Jan 2025. So this is the latest one. Again, as I said, you should always look for the latest directions which will help you go through the rules and regulations. I will show you how. So I've clicked on the directions. Again, over here, you can see it is updated as on 20th January 2025. If you see over here, there will be reference to the rules and regulations. Here is the reference to the regulation, and here is the reference to the rules. And if I just click on this and open it a new tab, again, if you see, these are the foreign exchange rules. With respect to FDI, foreign exchange management, mode of payment and reporting of non-debt instruments, regulations of 2019. And again, it is amended up to 15 January 2025. So you've got your latest rules over here with respect to FDI. If you click on the regulations, you will get the latest regulations with respect to the same. I just click on it and you get the latest regulations. Now that is update up to latest up to 2018, but as it has been referred to straight away by the latest directions, we understand this is the latest regulation which is there. Now we will try to search for ODI. Again, I'll just put the exact phrase which will help us much better. Yeah. If you see master direction overseas investment, again, July 26, 2024. So this is the latest one. Again, 2024 is the latest one. And if I see, here is the link to the latest rules, and here is the link to the latest regulations. So if I just click on it and I could just go here, these are the latest rules. And I just click on the regulations, I'll get the latest regulations. Yeah. So see, with respect to ODI, one good thing, if you want to study in detail about ODI, you just have to study. See, the latest rules and regulations have come up in 2022. So you just have to study the latest rules and regulations of 2022, the master directions of 2022. Also, master direction of 2024 have also come up, but they are in the same line. So maybe master directions of 2022 and 2024 and rules and regulations of 2022. So you don't need to go more upfront, and don't need to search previous years also. If you study these much, you will be well equipped with carrying out a transaction and also certifying whether certification is required. Okay. So now I'll just go back to my PPT. I'll just switch off these and I'll go back to my PPT. So I'm back to my PPT. So now let's discuss about the overseas direct investments. Now, as I said, if you want to refer to the latest rules, regulations, and latest information and knowledge about ODI, you just have to refer to the rules and regulations of 2022, the master directions of 2022, and also the 2024. Now, what are the key changes which they got in 2022? Earlier, they had defined joint ventures and wholly owned subsidiary. Now they have defined foreign entity. So they have replaced the term foreign entity with JV and wholly owned subsidiary, and they've defined the meaning of foreign entity. It means any entity formed or registered or incorporated outside India. So if you see, it includes LLPs too, and again you can see registration is not compulsory. It's registered or incorporated outside India. What is Indian entity? Indian entity includes companies, body corporates, LLPs, and even partnership firms registered under the Indian Partnership Act 1932 are covered. Now, when you see the ODI, you will find they must have mentioned that Indian entity can do this ODI, Indian entity can do this ODI. So, there's always a question which comes to our mind: which all type of entities can carry out an overseas for financial transaction? So, companies can do it, yes. Even LLPs and even partnership firms can make an overseas direct investment. In fact, even resident individuals can make an ODI. We will read more about them in detail. Now, earlier, an Indian entity which was not engaged in the financial service activity could not make ODI in an entity which is engaged in a financial service activity. Now, it has been allowed to do so. Now, what is the meaning of financial service activity? Basically, they have defined the activity as if this activity is carried out in India, whether it will require registration or regulated by the financial service regulator, which is the RBI. If the answer is yes, then if that entity is following up that type of a work, then it will be classified as financial service activity for your foreign entity. Now, definition of control. Now, when I say control, when I say and one entity exercises a control over another entity, when we speak in the parlance of Companies Act, there are two types of controls which we say. One is if I have the right to appoint majority of the directors, or I can control the management, or I can control the decisions which have been taken in the board meetings. Or secondly, with respect to the equity shareholding, I say if an entity holds 51% or more shares in the another entity, it exercises control. Over here, they in as per the rules of 2022, they have defined control as 10% or more. So if an entity has 10% or more holding in another entity, it will be as exercised as control. Now, why is this important? Why, if you see, there will be a lot. This will become very important with respect to the next definition. Now, because if one entity holds 10% in another entity, it will become a subsidiary of the first entity. So you have to understand that. And now there's a limit of the subsidies that a foreign entity can have. So if a foreign entity has invested in India, it can only invest only up to, it can only have two layers of subsidiaries. If it has more than two layers of subsidiary, then an ODI cannot be made in such foreign entity. I repeat, if a foreign entity has invested in India, it can have two levels of subsidiaries. So now the 10% criteria becomes very important. Any Indian entity cannot invest in such foreign entity who has more than two levels of subsidiary in India. A major change has been done in the definition of the net worth. Now they have defined net worth as and the same as the section 257 of the Companies Act. We all know the net worth definition of the Companies Act also includes your security premium. Now, again, why is this important? We will see later. There is a rule that how much amount can an ODI can be done. So basically, you can ODI can be done up to 400% of the net worth of as per the latest audited financial statements. So the calculation of net worth becomes very important. So if you can add your security premium account in your net worth, the limit for which your ODI can be done is now increased. Of course, you have to understand the revaluation reserves, write back depreciation and amalgamation. It will not be considered for net worth the same way as in Companies Act. Now, for companies, for corporates, net worth, it comes to our mind very easily. But what about partnership firms and what about LLPs? How do I understand the net worth for them? So they have mentioned for net worth, you have to take the capital account. So capital account includes the capital contribution which has been brought in by the partners, as well as the undistributed profit of the partnership firm or the LLP. Now there are three major modes of making a foreign financial commitment overseas. One is through equity share capital, one is through debt instruments, and one is by way of a guarantee or a pledge. Quantum of investment, as I said, an Indian entity can make a financial transaction overseas only up to 400% of its net worth as per its latest audited financial statements, which do not exceed 18 months. Now, I just want to explain over here. There's some questions which, when we were reading this, a lot of questions which came to our mind, and it came practically also. There was some challenges we faced practically. Now, if now we are in April 2025, okay, so the accounts of 24-25 may not yet been freezed, and the balance sheet of 24-25 may not have been prepared yet for any company, okay, for a lot of companies. So if I want to make an ODI in April 25, I can use the balance sheet, the net worth of the balance sheet as on March 24 right now. I can use this balance sheet up to 30th September 2025. We all know 30th September is the last date for signing for your AGMs. So your balance sheet have to be signed before 30th September unless there's an extension. So even if there's an extension, you will not be able to use that balance sheet. So if we are on 1st of October 25 and the balance sheet has not been signed, maybe because of the AGM has been extended or any other reason, you will not be able to make an ODI because you will not be able to calculate the net worth. You will not be able to use the March 24 balance sheet. You will have to use the March 25 balance sheet because the March 25 balance sheet you have to submit by September. So you will not be able to use that. So that you have to take into mind. Secondly, it says audited financial statements. It does not say statutory audited financial statements. So what I mean is, what I interpret is, even if a special purpose audited financial statements are prepared, net worth can be calculated on that basis also, and ODI can be done on that basis also. So, for example, there's a company, he makes a special purpose financial statements of his 24-25 financial year in April. And he can use this balance sheet for making an ODI. Then he need not use that March 24 balance sheet. Okay. Even if now with respect to that same, even if the entity is in his first year of incorporation, of course, it will not have a net worth. Net worth will only come by the capital, by the capital introduced by the shareholders. It will not have that much profit in the first year, maybe. So it can also prepare a special purpose financial statements in his first year, and it can do an ODI. Now, there's another limit with respect to the quantum. Even if each transaction, each time when you're making ODI, you have seen it cannot exceed 400% of your net worth. But if the foreign financial commitment in a financial year is exceeding 1 billion US dollar, approval of RBI will be still required, even though your financial commitment of the Indian entity is within the eligible limit under the automatic route. So, if an Indian entity is exceeding his financial commitments, overseas financial commitments more than 1 billion USD in a year, approval of RBI will be required. Now, this limit of 400% will not apply if the investment is made out of balances held in exchange earners foreign currency account of the Indian party of funds raised through ADR GDR. So basically, these are the foreign currency accounts which, if they were a non-resident earlier and they have this money in the foreign exchange earners foreign currency account, it can be done through them, and that 400% limit will not apply. Earlier, there was this concept by which a holding company or a subsidiary company could use each other's net worth. But now you cannot do that. You have to see that specific company's net worth when you're making the ODI. There are certain case studies. I will read the questions and I'll answer them also. So now, one question which also came to our mind was when we were doing an ODI, we had an balance sheet which were being prepared in Ind AS. Now, this company had issued redeemable preference shares. Now, we all know for Ind AS, these redeemable preference shares are not a preferential capital. It goes in your liabilities. What is the difference in accounting standard? You will treat it as a preferential capital. If you're preparing the balance sheet as per the accounting standard, you will treat it as a preferential capital. But in Ind AS, you will treat it as a liability, the redeemable preference shares. So now, what do you do? How to calculate a net worth? So the answer is, see, the law they have said you have to refer to the latest audited financial statements. So whatever is applicable to the entity and however they have prepared their audited financial statement, you have to refer to the net worth. So for example, in an Indian entity who had Indies who was required to make his financial statement in Indies, we have to see the net worth as per the audited financial statement as per Indies. If there's an Indian entity who is following accounting standard and Indies is not applicable to them, then net worth as per accounting standard will have to be used. So whatever the entity is following or which is required to be followed, you have to use the net worth on that basis. This example, this is question which I already given answer. I'll just read out the question and the answer. A company wishes to make an ODI investment in May 2024. Let's say now April 2025. Let's just change the question to April 2025. So for calculating 400% of the net worth, the financial statement of which reporting year should be considered? He can get a special purpose audit done as on May 25, or he can use the balance sheet of March 24. Now, what are the documents which are required when you're doing an overseas direct investment? Basically, now first you have to understand ODI. All documentation has to be submitted in hard copy. It is offline. So there's a form FC, which basically means form financial commitment. So that has to be filled in. It has to be signed by the management. When the first time you will file this form ODI, you will get a UIN from the RBI. This UIN is basically a unique number given for that investment of the Indian entity into that foreign entity. So whenever next this Indian entity is reinvesting in that foreign entity, you have to use that UIN. So suppose an Indian entity who has investment in different foreign entities will have different UINs for all these different foreign entities. A statutory audit certificate is required, as we discussed, without which a ODI transaction will not proceed. And we will discuss the same in detail in the later slides. The board resolution is required because an Indian entity is making this overseas investment. So a board resolution from the Indian entity is required. Also, the board resolution of the foreign entity will also be required. If you're investing in equity shares, your valuation report will be required. Because see, whenever you're saying, whenever you in equity shares come into play, your mind goes to what value can I acquire these shares? So we will read further, but it has to be as per the arm's length price, as per the applicable valuation methods, internationally recognized valuation methods. The underlying document has to be there. See, any type of ODI, suppose if you are making an investment in equity shares, there has to be your share, there has to be a shared agreement. And if you're making a commitment with respect to a loan, if an overseas loan has been given, there has to be a loan agreement. If a guarantee has been given, a guarantee agreement has to be there. So the underlying agreement has to be there, and it has to be signed. Then the AD bank will always also ask for a declaration from the Indian entity that all the compliances with respect to the rules and regulation of ODI have been complied with or not. Now, this is an FATF compliance. What is the full form of FATF? Is Financial Action Task Force. Now, what we'll do is we'll go online and we will just go to the website of this FATF and see what's it. Basically, it is an agency, it is a watchdog which regulates whether a country is entering into transaction with respect to terrorism or money laundering. So it regulates those countries and the transactions, and it evaluates whether some countries may be need to be put into increased monitoring, or there should be there are some countries which they think are engaging in these practices and where transaction should be avoided. So they'll list out those countries, and while making an ODI, the management as well as the statutory auditor, you have to check whether that the overseas investment is not being made in a company which is a resident of those countries. So what we'll do, I'll again come out of my PPT and we'll just go to the FATF portal and see. So this is the FATF portal. If you just type it on Google FATF, it just comes up. It's a Financial Action Task Force. If you go to the countries, here it gives high risk jurisdictions and jurisdictions under increased monitoring, and they give the whole list. Now, this is as per the latest meeting which they have held which is on 21st February 2025. They have held a meeting in Paris, and then they have mentioned, they have listed out the countries where the increased monitoring is required. So, for example, Korea is there, Iran is there. So you have to now, as an auditor, as a statutory auditor, when I'm certifying the certificate with respect to ODI, I have to make a document of this. What I have to do is I should download this with a date stamp, that when I checked and when the ODI was being done, this country was not under the FATF watch list, because this keeps on getting updated regularly. So now there's a meeting in 25. Regular meetings are done and regular reports are generated by the FATF. So suppose now you have made an ODI, and maybe after 3 months, that country comes under the increased monitoring jurisdiction. So you should have a document with yourself that at the time of ODI, it was not under the high risk jurisdiction. It's very important documentation has to be maintained. It should be there in your file. I'll again come back to my PPT. So, and in fact, even if you're making a current account transaction, let alone a ODI, even if you're making a current account transaction or a capital account transaction, you have to check whether you're not remitting any money to a country which has been notified or reported by in the FATF report. Form A2, we all know whenever we are making a foreign exchange transaction, the bank asks us to fill the Form A2, which is a declaration to allow him to make that remittance, where you have to select the code for the remittance being made. So these are the basic documents which are required for the ODI, and you need to have a checklist. When you undertake a task of ODI, we need to have a checklist for the same. Now the ODI form, basically the Form FC, it has various parts and sections. So the section A deals with basically the details of the Indian party or the resident individual. So you have to give the name of name of the Indian party, the address, the concerned person, the shareholding person. So these all details you have to mention. Section B, you have to give the details of the foreign entity with respect to the name, the address, the activity code, because that is very important. What activity the foreign entity is engaged in. Then you also have to mention the amount of foreign commitment being made, the sum total of the foreign commitment already being made. So that comparison comes over here. And if that foreign entity has any step down subsidiaries, those details also have to be mentioned over there. Then in the section C, you have to give the details with respect to the nature of investment being made, whether it's a loan, whether it's equity share capital, whether you're making an ODI by guarantee or creating a charge, that has to be mentioned. Form D is the declaration I told you about. So basically, if you read the declarations, you basically have to give basically the management has to give an undertaking whether all these rules and regulations have been complied with, whether your pricing guidelines have been complied with, if any NOC is required, whether that regulation has been complied with, whether any earlier share certificate has been submitted. I'll discuss with respect to each and every of these guidelines in detail one in the next slides. If is a resident individual, and ODI can be made only up to the limit of the LRS. We discussed for and for any Indian entity making an ODI, it can make up to 400% of its net worth as per the latest audited financial statements. But for a resident individual, the limit is your 250,000 USD per year, which is your limit under the liberalized remittance scheme. Section E, which is more important and paramount to us, is a certificate by the statutory auditor. And if you go to the certificate, you have to study the ODI rules and regulations, because we will be certifying with respect to each clause, whether if clause and with respect to the transaction. Suppose the transaction is in equity, whether the rules with respect to equity have been complied with or not. If it's a transaction with respect to loan, whether the rules and regulations with respect to the same have been complied with or not. So everything step by step you have to mention with respect to the in the certificate. Then the part two is the annual performance report. Any Indian entity, once he has made an ODI, once a overseas financial commitment has been given, they have to file an APR every year. Currently, the due date is 31st December of the next year. So for March 25, the due date will be 31st December 2025. So this has to be submitted. Form MC Part 3 is basically reporting on a disinvestment, maybe by way of sale, by transfer of shares, by liquidation, or winding up, or whatever the case may be. Now, when you go to the certificate, one important provision which has been mentioned with also in the rules and also in the certificate, your previous compliances all have to be complied with if you want this ODI to be made. So you need to know what are all the compliances which a company has to make and whether it has been complied with or not. If there is a delay, if a compliance has not been filled or not been filed, you may not be able to make another ODI. So there are some compliances which we have to take care of. Now, once an ODI is done, once if so for example, an Indian entity has invested in share capital of another foreign entity, so you will get your share certificates of the foreign entity. The Indian entity will receive the share certificates because he's invested in the equity share capital. Now, these share certificates have to be submitted to the AD bank within 6 months of the transaction. Okay, and very important, very paramount, you should consult the management to take an OC of the certificate submitted to the AD bank. We had faced a case where the Indian entity had submitted the share certificate with the AD bank. However, somehow the AD bank misplaced the certificates. They could not find it. And after 6 months, they issued a notice to them. You have not submitted us these share certificates. Now, that would have led to a major non-compliance. However, the management had on board the OC copy, which the bank had given. The bank had given an acknowledgement. The acknowledgement copy the management had, and that we could prove and it could protect himself. Form APR, whether if an ODI, see, if an Indian entity has done a previous ODI and now wishes to make another ODI, whether the form APR with respect to the last year has been filed or not, or if any form FLA also has to be filed, so whether the form FLA has been filed or not. So as a statutory auditor, when I'm certifying the statutory audit, I take all this documentation in my document, I mean in my file. I will take the document of the FATF. I will take the document whether the previous share certificates have been submitted or not. The acknowledgement I'll take in my copy. The acknowledgement copy of your form APR. The acknowledgement copy of your form FLA. So these all I will keep in my file. And that has to be documented and kept with us. Because we will be certifying whether all the previous compliances have been followed or not. Now, if you want to discuss about APR, so as I said, any entity who has made a foreign investment, a foreign commitment, will have to file a form APR. It's an annual performance report. Basically, it contains details of the foreign entity share capital, net worth, and profit loss. These are the main three figures which it requires. So what documentation has to be obtained is you need the audited accounts of the foreign entity. if mandatory control exists. For example, an Indian entity exercises control over that foreign entity, then mandatory the accounts have to be got audited of the foreign entity. Now this audit has to be done over there only. It has to be done from the foreign chartered accountant. It has to be done in the foreign country. So see, now there may be cases where in a foreign country such law may not be applicable to that entity. However, as per the rules, if the Indian entity exercises control over the foreign entity, the foreign entity will have to get its account audited and they have to submit it to the Indian entity to file the form APR. So this is very important. We also faced this situation earlier and we had to convince the foreign entity that this will be required. As I mentioned, the share certificates of the previous remittance should be submitted to the bank within 6 months of the remittance. And again, see, the point which they have mentioned is if it has not been done, this investment will have to be repatriated back. It will have to be received back. These funds which you have made, you will have to get it back. Now, form FLA, see, any Indian entity who has either received FDI or has given ODI has to file a form FLA, foreign liabilities and assets. That has now currently the due date is 15th of July. So for March 25, it will come on 15th July. So that also has to be filed. Now the statute audit certificate. So these are the various clauses of the certificate. If you see, it straight away asks about the rules and regulations, whether this rule has been complied, whether this regulation has been complied, and then you have to say accordingly. So the first point they ask is whether the remittance is not in violation of the provisions contained in Rule 19 of the Foreign Exchange Management Rules 2022. Now, if you see the Rule 19 of this Overseas Rules 2022, it is basically with respect to the restrictions and prohibitions, which I have mentioned later in my PPT. So whether this ODI which you are doing is not under whether it is under the restricted prohibitions. So you have to see if there are certain there are certain sectors in for which there's a restriction for making an ODI. So the investment should not be made in those sectors. So you have to refer to that rule and you have to see the restriction and you have to comment with respect to the same. Then you have to certify that the total financial commitment along with this proposed financial commitment is not exceeding 400% of the company's net worth, Indian company's net worth. Then if the overseas investment is done in equity shares, then whether the pricing and valuation norms have been followed or not. If ODI has been done in a financial service activity, whether the conditions which have been mentioned with respect to investment in financial service activity have been complied with or not. See, these all specific regulations we will discuss in detail. Right now, I'm just going to the certificate and everything we'll discuss step by step. Then whether Regulation 12 of the Foreign Exchange Management Overseas Investment Regulation 22 have been complied with or not. Now here, the Regulation 12 states that whether all your previous compliances have been complied with or not. So here you are certifying that all your previous compliances with respect to ODI have been complied with. So if you can read, the regulation states that a person resident in India who has previously made a financial commitment in a foreign entity shall not make any further financial commitment directly or indirectly towards such foreign entity or transfer such investment till any delay in reporting of earlier ODI or share certificate is regularized. Now, if the commitment is with respect to the personal guarantee given by a director or promoter of the company, whether it is within the limits and whether it is within the rules and regulation with respect to the giving of guarantee. So if you see, you have to understand, first of all, which mode is your ODI being done in, and with respect to the same, you have to answer the clauses of the certificate. See, you have to give the answer for all of them. Suppose, for example, if one of the clauses is not applicable to you, do not remove it. Just you should put it in brackets, not applicable. Suppose, for example, an Indian entity is not investing in a in a foreign entity who is engaged in financial service activity. So, with respect to this clause, in the end, you mentioned not applicable, but do not remove it from your certificate because it's a predefined format. And what is the checklist or documentation a statutory auditor should maintain when you are doing this certification? See, friends, you have to understand. We all know the importance of a certificate. A certificate means you are certifying true and correct. When you are signing a balance sheet, it is basically true and fair. But when you are signing a certificate, you are stating on true and correct. Now, over here, you are giving a certificate. You are giving a certificate with respect to funds being going outside India. So funds are going outside India. there's RBI involved, there's Enforcement Directorate involved, funds are going outside India, and you as a statutory are certifying. And on your certificate, the AD bank is going to place a lot of reliance. As I said, the AD bank has the power to approve the documentation and all the forms, and they will play at least some reliance on the statutory auditor. So you are certifying, you're making a certificate, you have to be very sure whether all your documentation as per your auditing standards have been followed or not. And all the rules and regulations, you need to have a checklist whether they have been followed or not. Whenever we do an ODI, we prepare a whole file. There's a checklist. There is a lot of QC also being done. There's a lot of quality check being done, and then we first send it to the AD banks for approval, and then the signing is done. So, what are important documents you should have is, as I said, you need to have the underlying document, the signed underlying document. If you're making in ODI in equity, the share purchase agreement has to be there. If you're making an ODI, if you're making the Indian entity is giving a loan, the loan agreement has to be there. The guarantee, if there's a guarantee agreement has to be there. It has to be the signed copy has to be there with us. Um, then you have to have the whole calculation. See, when I say an Indian entity can invest up to 400% of its net worth, it sounds simple. But when you try to understand, if an Indian entity has done a lot of ODI, has made a lot of ODI transactions to separate entities, now to keep a track of how much financial commitment he has given, it is quite difficult. I'll explain you how. What see, uh, what you will suggest is, I will download the ledgers of the Indian entity. I will check for the investment in the loan account, and I will get to know my total financial commitment. But what about the guarantees? What about the shares pledge? This you will not be able to get from the ledger. So you have to document, because see, when you've done an ODI, you are the statutory, you are certifying all these ODIs. So you have to keep a track of all the previous ODIs they have done, whether and which are entities. So you have to keep a track of which entities the ODI has been done and which modes they have been done. Equity share capital, loans, guarantees. With respect to the loans and your equity shares, match it with the ledgers. With respect to the guarantee, check the documentation again. Also, when you go to you can also request the AD bank. See, AD bank also keeps a ledger of the ODI which the entity has been done. So they also keep a ledger. So ask your management to ask the AD bank for the ledgers they have and cross check with it. Always do this cross check, because by chance, if that 400% has been exceeded and you have missed out, if you have missed out in taking some financial commitment an Indian entity has done, and you have missed out in adding that or in that calculation, and the remittance goes more than 400%, there'll be a huge violation of RBI. Because see, you have been allowed to you have been allowed to do it as per on the without the approval route. You can up to 400% you are freely allowed to do it. But more than 400%, you will require the approval of the RBI. So if you have remitted more than 400% by maybe a clerical mistake and RBI approval not taken, it's going to be a big error, and it may lead to huge penalties. The valuation report has to be there. If investment in equity share, the valuation report has to be there. You have to check the pricing guidelines. As I said, the pricing guidelines is, it has to be at the arm's length price as per the internationally accepted valuation methods. Then you should also document the sector in which the ODI is done. Whether the foreign entity, what sector is it involved in? If it is involved in a strategic sector, if it is involved in a financial sector. So these all have different specific rules and regulations. The strategic sector, financial sector, they have specific rules and regulations. So you ask for the MOA of the foreign entity, ask for the articles of the foreign entity. Also, there's one more compliance. If the foreign entity is a startup, then there's a condition that the Indian entity can only do an ODI in a foreign entity who's a startup through his own funds. Uh, For example, that means an Indian entity cannot take a loan and then fund a foreign entity who's a startup. So how do you know that foreign entity is a startup? You'll have to check this, maybe it's articles, or maybe you will have to take a declaration from the foreign entity. Then, as I said, the previous ODI compliances, whether they have been done or not, you have to document that. Obtain acknowledgement of all the forms which are required to be done. Upon acknowledgement of the share certificates which they have submitted to the bank, that letter of submission of the share certificate to the bank, obtain it and keep it in your file. A management representation letter is also important, because a lot of because to understand of what ODI is being done, and mention the calculation also, whether it is another 400%, mention it in the ask the management to mention it in the management representation letter. Now see, in the certificates, basically, you cannot modify the certificate. It has its own format. However, you can give your appropriate disclaimer or appropriate notes, which you can, if you want to help the readers to understand some things. So the auditor can give notes in the certificate if you want to bring some important points to light. For example, in one case I saw is an Indian entity had made a foreign commitment. He had transferred the money outside India to purchase of shares. However, that purchase got cancelled and the money was supposed to be got back. It was within a time limit. However, whether to consider that within the 400% limit or not, that was the question. So we had included that. We had included that as a commitment. Though it was supposed to be got back, we had included that as a commitment, and we had mentioned in the notes that we are including any amount has been remitted outside India, which is now the transaction has been cancelled and we are going to receive back the money. However, we have still include that for the calculation of 400% of the net worth. Valuation, as I said, it has to be done as per the internationally valuation has to be done as per the internationally accepted pricing methodology. Now there are various methodologies which you can do it. The discounting factor method is one method. Then there's the net worth method or your market method. So you have to see which is the best methodology for the valuation, and the best one you can accept it. Now the valuation report can either be signed by a chartered accountant or by a merchant banker. Now, what I have seen is normally if a foreign entity has exceeded 5 million USD, is made more than 5 million USD ODI in another entity, normally banks have asked for a merchant valuation report from a merchant banker. That's what I've seen. I've not found it in the rules, but that is what the AD banks normally ask for. FATF compliances, I've already explained the same to you. So I'll skip this slide. Yeah, restrictions and prohibitions. We also in the statutory certificate there are various. We have the first point only we had to mention whether this ODI is not included, not in the anything which is mentioned in the restriction and prohibition listed. Now, what are the restrictions? So this we have discussed. An ODI cannot be done in a foreign entity who is investing back in India with more than two levels of subsidiaries. Then, if any ODI has been done in a startup, in a foreign entity who is a startup, it can be only done by its own funds and cannot be done by taking a loan by an Indian entity taking a loan. Then, if there's any foreign entity which is registered or incorporated in Pakistan or any other jurisdiction which may be advised by the central government of India, approval may be required before doing an ODI. However, these restrictions which we have mentioned, these three restrictions, they do not apply to banking company, NBFC, insurance company, and government companies. Yeah, again, one primary condition, an Indian entity cannot make in for ODI in a company which is in any country which has been reported as a in the FATF portal. Now, there may be cases where an Indian entity who may have taken some loan and have any of the assets which are now a willful defaulter or which have been recognized as a non-performing asset. So if such is the case, an NOC will be required from the relevant agencies. Now, why is it required? See, an Indian entity has taken a loan. Now, he's not been able to repay back this loan, and his assets are classified as a willful defaulter or NPA. He cannot repay back his loan, but he wishes to make an overseas financial commitment. So, of course, he will not be able to make it unless he receives an NOC from that relevant agency to make this ODI. Now, Indian entity has applied for the NOC. However, the NOC is not received within 60 days. Then it is assumed as a deemed NOC. They have also mentioned it in the rules and regulations. Now, three primary restrictions are the real estate sector. Now, when you say real estate sector, they mean buying and selling of real estate or trading in TDR. It does not include development of townships or construction of residential and commercial premises, roads, and buildings. So, if you are making an investment in a foreign entity who is engaged in development of townships or development of construction of residential and commercial buildings, then it is okay. But if it is only for buying and selling of real estate or buying or selling of TDRs, then it is a prohibited sector. In ODI and gambling, then dealing with any financial products which is linked with the Indian rupee. So these are the another restrictions. Some things we should keep in mind while making an ODI. All transactions related to a joint venture or wholly subsidiary should be routed to only one branch of an AD. Actually, Normally, whenever you have an AD bank, you have to get all the transaction through one AD bank only. If there's a change of the AD bank, there's a whole procedural aspect which has to be done, because how will AD bank also maintain the count of how much overseas commitment has already been done? So in Indian entity, if he's allowed to make if he's allowed to use two AD banks to make ODIs, there will not be enough control to control whether the 400% net worth has been exceeded or not. So it has to be done only through one AD bank. If then you can change it after some time. If there is a problem, you may change that AD bank. But there's a whole procedural aspect. There's an NOC also required by the new AD bank from the earlier AD bank. Then foreign currency accounts cannot be opened abroad for making these ODIs. Even when you're making an payments to your branch offices or licensing offices, you cannot make remittance to the branch office for them to make an ODI. Then one more condition is an Indian entity once, if an Indian entity who has made an ODI, and if there's a disinvestment or there's the sale of the investment, he should get back the proceeds within 90 days. He should try and get the amount which is invested or amount which is sent within 90 days. He should get it back. Delays in reporting. So if there's a delays in reporting, up to 3 years, you pay your LSF, you pay the late fees, and it's okay. But more than 3 years, penal action may be taken by the RBI. You can apply for compounding although. Then see, further ODI will be not be allowed to the Indian resident after the delay is regularized. We've already seen that. So we should always advise the client to avoid these delays. And also one thing, you should always advise the client, even after the ODI transaction has been done, those share certificates have to be submitted to the AD bank. So our work does not end over here. And if you see the LSF, basically it's 7,000 rupees, 7,500 per return with respect to the filing forms. For example, any APR filings or FLA filing is 7,500 per return. But if it is with respect to a transaction-based form, for example, ODI form or FDI, then there is a percentage of the amount involved for your penalty, for your late fees. Now, there are certain cases where there's a general permission for making this ODI if the purchase or acquisition out of funds held in the resident foreign currency account, basically the non-resident in India who had received this, who had earned this money and who have still kept that funds in their non-resident resident foreign currency account, they can make an ODI from there. Or out of any foreign currency reserves held outside India by a person who is employed in India uh, during a specific, for example, non-resident who has now come to India and is employed only for a specific duration, which does not exceed 3 years, and who has his foreign currency reserves over there. He can make the remittance. I mean, it's a general permission for the ODI. An Indian person, if as I said, basically any non-resident who has now come into India, and if he holds those foreign currency money outside India with respect to the rules and regulations, then he can. There's a general permission for him to make the ODI. Now the various modes of making the ODI. One is the share capital. So how, if you see the rules, they will tell you in which all modes and can an ODI under equity share capital can be done. It can be done either by subscribing to the MOA. It can be done through the bidding or tender procedure. It can be done by rights issue, by bonus issue, swap of securities, by mergers, demergers. So the various modes they have mentioned by which investment can be done in equity share capital. Now, with respect to rights and bonus issue, if an Indian entity is investing in the rights issue, it will form part of ODI, it will form part of the 400% limit. But if he receives bonus shares, then there's no actual outflow of money. There's no actual outflow of money. So it will not be included in your 400%. It will not be considered as a fresh financial commitment. So it will not be counted as a in your 400% limit. Now, debt instruments. An Indian entity. Now, there's some restrictions and conditions also with respect to debt instrument. An Indian entity can give a loan to its foreign subsidiary. So first of all, you have to understand Indian entity can only give a loan to a foreign entity from in which it has control. So it cannot give a loan to a foreign entity for which is not a subsidiary of its. Then one more thing is a resident individual cannot make an ODI with respect to a loan. So a resident individual can invest overseas in equity share capital, but he cannot give a loan overseas. So there's a specific restriction with respect to the same. When a loan is being given by Indian entity, the bona fide document is a must. And in that document, the main thing is the mention of the rate of interest. A loan of an Indian entity cannot give a loan to a foreign entity interest free. It cannot give an interest free loan. It has to be as per the rate of interest, and this rate of interest has to be as per the arm's length price. Now, again, some questions come to our mind. How do you define arm's length price? Whether you have to see for India or for the foreign country. According to me, you have to see arm's length price as per the rate of interest as per the foreign country. For example, if an Indian entity has given a loan to a foreign entity who is in Japan, now maybe Japan interest rates are quite low. Comparatively, maybe they are 5%, 6%. But in India, the interest rate may be quite high with around 12%, 13%. So if I have to compare ALP, why will the foreign entity take such a huge interest, such a huge loan with such a huge interest from India? So you have to consider the rate of interest, the arms and price for rate of interest as per the foreign entity, as per the foreign country. Then in which all modes can the investment in debt instrument be made? It can be made through government bonds, corporate bonds, borrowings. So these are they have mentioned the same. Now, in an Indian entity who has acquired control in a foreign entity may have to give a guarantee. Why they may have to give a guarantee? Because maybe that foreign entity has taken a loan from a foreign bank. So the foreign bank will ask the Indian holding company to give a financial guarantee. So that Indian company can give this guarantee only to its subsidiary or only to its holdings, only its ultimate subsidiary. Now the conditions are it cannot be open-ended. And if it's a performance guarantee and that the time specified for the completion of contract shall be treated as a validity period. Now, if this guarantee is invoked, for example, an Indian entity has given a guarantee to the foreign bank of the foreign entity. So this will count as a financial commitment. Now, the foreign entity has not been able to repay back the loan. So the guarantee has been invoked, and the Indian entity now has to pay that amount to the foreign bank on behalf of the foreign entity. Now, when he's paying this amount again, now this will not get added to that financial commitment because when it had given a guarantee, it was already counted as a financial commitment. So you just go from a non-financial commitment to a financial non-fund based commitment to a fund based commitment, but it will not be counted again with respect to a financial commitment. This count is important because you can only give ODI up to 400% of your net worth. If there's a rollover of guarantee, it will not be treated as a fresh financial commitment. And once the guarantee agreement has been signed, any end user terms and condition cannot be changed before the approval of the bank or the RBI. Now, there may be a case where an Indian company may have to give a guarantee on behalf of the foreign entity. This Indian entity can only give this guarantee if it is eligible to make the ODI as per the rules and regulations of the ODI. And and whether it has the limit of 400% still there. So it can give this guarantee only up to that 400% limit. It will be counted in the financial commitment limit. Now, there may be a case where there are two holding companies. There are two companies who hold more than 10% in a foreign entity. Now, both these companies are required to give a guarantee for the loan taken by the foreign entity. Now, the guarantee is for 100 crores. Okay. And both the Indian companies have given the guarantee on behalf of the foreign entity. Now, how much will the financial commitment be counted for each entity? Whether it will be counted 100 crore each or it will be split 50 crore. My answer is it will be counted as 100 crore each because each entity is individually liable. If the guarantee is invoked, any of the entity may be asked to pay that money. So when you're calculating the total financial commitment, you have to consider the 100 crores with respect to each company. And that's the same case study which I mentioned over here. Now, ODI and financial service activity. As I said, financial service activity they've defined is if an Indian entity is carrying out any activity in India and it requires approval or registration or under the regulation of any financial authority like the RBI, then such activity is being carried out outside India also it will be considered as a financial service activity. So and earlier Indian entity was not allowed to make an ODI in a foreign entity was engaged in financial service activity. Now it has been allowed to do so except with respect to insurance and banking. But there are conditions for both. So, and So an Indian entity can make a ODI in financial service activity only if it has posted net profits during the preceding 3 financial years. So there has to be a profit. There has to be net profit for preceding 3 financial years. If it has been registered with this Indian entity is registered or regulated by the Financial Service Regulator in India, and it has approved approval as required by the regulators, both in Indian country and host country. As I said, an Indian entity who is not engaged in financial service activity may make an ODI in a foreign entity who is engaged in financial service activity, except banking and insurance. So they can make they may be engaged in professional advisory or wealth management. That is allowed. However, there's still a condition. The Indian entity should have posted net profits during the preceding 3 financial years. ODI by a resident individual. The limit is 2,50,000 USD per year as per the LRS scheme. They can acquire equity shares through rights issue, bonus issue. They can acquire equity shares through sweat shares. They can see now if they receive any gift or receive any inheritance, then that does not come under the limit of 2,50,000 USD. Then sometimes if the Indian resident individual is a director in a foreign entity, he may receive those minimum qualification shares that he can acquire. They can receive ESOPs. So when you look at the rules, regulations, and directions, the rules will tell you which all modes are allowed, which all ways investment can be done. The regulation will tell you which all modes are allowed. If you're doing equity share, these are the modes allowed. If you're investing in debt instrument, these are the modes allowed. If a resident individual is is making a financial commitment abroad, who is investing in equity shares, which are the modes allowed? They've mentioned over there. Now, in ODI can also be done through the deferred payment. For example, if upfront payment has not been done and the condition is it will be deferred, the payment for the purchase of shares is deferred, that can be done. However, there are some condition which is the same. When you're deferring the payment, even though you're deferring the payment, the equity shares should be transferred at the time of the first payment. So you should receive the equity shares at the time of the first ODI only, though the payment for the same will be deferred. Also, when you're calculating the financial commitment, you have to calculate the total amount and not only the deferred payments which you're making. You have to consider the total financial commitment which you're going to make. And also, there has to be a proper agreement, and the agreement should also specify the amount deferred and the time for the deferred payment. So that has to be there. So a deferred payment is allowed for acquiring equity shares of a foreign entity, but with respect to the rules and regulations of the same. A person resident in India may transfer his investment in equity share capital if it is in compliance with the pricing guidelines, documentation, and reporting requirements as per the rules and regulations. Again, the pricing guidelines, it has to be the arm's length price if they're selling off the transactions. So if an Indian entity, if there's a person resident in India, and if he's want to sell the shares acquired by overseas shares acquired by him, it has to be done at the arm's length price again. Now, who can he transfer to? He can transfer to a resident if the resident is eligible to make such investment. He can also transfer these shares to a person resident outside India. Of course, there's been FCTRs which may have to be done. From FCTRs will have to be filed because there's a transfer of no, but FCTRs will have to file if there's a transfer of shares of an Indian entity. So the various reasons why there may be liquidation is maybe because of amalgamation, because of demerger, maybe because of sale of transfer of shares. But you should receive back. You should receive that back the amount of investment or your sale proceeds within 90 days of such transfer or disinvestment. If the foreign entity is liquidated, then you should receive back your capital within 90 days of the liquidation. Maybe not capital, the net realizable proceeds. The net realizable value of your asset which which you are allowed to withdraw, you should get it back within 90 days of the liquidation. The condition, one more condition is this investment cannot be done within 1 year of making an ODI, except if there's a merger or demerger. So they just want to prevent any fungy transactions. So it has to be legit. Normally, when we're making an investment, I will not transfer or sell it within 1 year. So they want to give us a check on it. So they have kept this condition. This investment can only be made within after 1 year of making the ODI. And then Form FC. Now, Form FC will also have to be filed again. It has to be done within 30 days of the receipt of the disinvestment proceeds. So conclusions is basically if you want to learn through the ODIs, you have to read the rules, regulations, and directions of 2022. The directions of 2024 also there. The provision of statutory certificate are very important. Documentation, auditing standards have to be followed. We should have a checklist and quality check for making this ODI transactions. Now let's see which are the important forms and filings under FEMA. First is the list out the forms. One is the form FCTRS, one is the form FCGPR, and there's a form FC, which we discussed with respect to ODI. There's form DI, which is with respect to downstream investment. Then there's form LLP1, LLP2. So form LLP1 is basically if an LLP is receiving FDI, if it's receiving foreign direct investment, you have to file form LLP1. And if the LLP is repatriating back that for FDI, then it has to file form LLP2. Then there's a form APR, the annual performance report, which I've said it has to be filed by all the entities who has made an ODI. Then there's a form FLA, which has to be filed by any Indian entity who has either received FDI or who has made ODI. Then there's a soft tax form, which sometimes a lot of people miss out with. We'll discuss the same also. This form 15 CCB mostly is with respect to Income Tax Act, but as it involves foreign payment, I've mentioned it over here. So form FCTRs, basically what the full form of form FCTRs is foreign currency transfer of shares. That's the full form. So basically what is it required? When the shares of an Indian entity is being transferred between a resident and a non-resident. This form has to be filed online. Now there's a RBI has two portals. One is the FLAIR portal where your form FLA has to be filed, and one is your firms portal FIRMS where the SMF forms have been notified. So FCDAS comes in one of those SMF forms, and it has to be filed at the firms portal. So this is a form which has been filed online. Who is required to file? The transferor or the transferee, who is the resident in India. See, as I said, any Indian entity whose shares are being transferred between a resident and non-resident. So whoever the transferor or transferee who is a resident of India, he has to file the form FCTS form on the FEMA portal. Now, what are the documents which are required? First of all, the consent letters will be required of the transferor and the transferee. A valuation report. Again, see, there's a transfer of shares involved. A valuation report is a must. Again, it has to be at the arm's length price. So your valuation report is important. Your share purchase agreement or your share transfer forms are a must. Then a declaration will be required from the buyer that is eligible to purchase these shares under the FDI policy, under the existing secretarial limits, and other pricing guidelines have been followed. So they have. And now, if you see, they have given a specific Annexure 6. So they have RBI. If you go to the RBI's portal and if you download the directions, you will get this specified format. It's the Annexure 6. So that has to be filled in and signed by the foreign non-resident. If the sellers are NRIs or OCB, then copies of RBI approvals, if applicable, will be required. It will evidence whether the shares actually purchased by them were on repatriation basis or non-repatriation basis. If they're non-repatriation, they may not be able to transfer the shares and may not be able to receive back the money. Again, no objection certificates and tax clearance certificates from the income tax authority. We all must have faced this whenever we are when there's a transfer of shares involved, there's capital gains involved. So an Indian entity's shares are being transferred between a resident and non-resident. So capital gain will be taxed in India. So a form 15 CACB is a must. It will be required wherein the chartered accountant will also certify whether the TDS has been done on the same. Right now, we all know the TDS has to be done on the total amount of your sale proceeds. Otherwise, you may go and obtain a lower tax deduction certificate from the income tax department. So you have to apply for that. So that also we as consultants can help we can help our clients with respect to the same. Again, when shares are being transferred between a resident and non-resident, KYC of the non-resident transferee is required. So if the non-resident is a transferee, his KYC from the foreign bank will be required. So this is a must. So these are the checklists which we need to have, because these documents will be checked when you file this form online. You have to attach these documents also online on the firm's portal, and the AD bank will check these forms. They may raise a query. They may ask you to attach certain more documents if they are not in order, or they may ask you to attach some appropriate more documents, and that again will have to be filed. So make sure you have a checklist and make sure all the documentation work is done, because see, any document, any transaction between a resident non-resident, a lot of signing will have to be done by the non-resident party also, and it takes time. Sometimes the non-resident is an individual. Sometimes we have seen cases where the non-resident is an individual, and you have to actually explain to them the transaction, the rationale of the transaction, and the documentation and what he is signing. So these are all the aspects where a consultant and CA can play an important role. Allow me a minute. Thank you. Then there's a form FCGPR. The basic full form is Foreign Currency Cross Provisional Return. Basically, if any if an Indian if an Indian entity has issued shares to a non-resident investor, then he has to file a form FCGPR. So this Indian entity is receiving FDI, is receiving foreign investment, is issuing shares to a non-resident investor. A form FCGPR will have to be filed. It has to be filed within 30 days from the allotment. Again, it has to be filed in the forms portal, SMA forms portal. Who is required to be filed? The Indian company who is issuing these capital instruments to the non-resident. Documents valuation report, because what value is he subscribing to the shares? The valuation report of the Indian entity will be required. The FIRC, because foreign investment is coming in, it has to be come through the AD bank. The FIRC will be required. Once the FIRC received, only then you will be able to file the form FCGPR. If you see the form also, it will ask you the date of the FCGPR, the date of the FIRC, and the date of the receipt of the proceeds, and it will ask you the attachment also. So you have to attach that document also. Then there's a certificate from the company secretary is also required. Whether all the rules and regulations with respect to the RBI and the Companies Act have been complied with or not when the company is accepting of FDIs. The board resolution is required by the company who is allotting the shares. Again, when the non-resident are subscribing to the shares of the Indian entity, a KYC of the non-resident party will be required. He can get a KYC from his foreign bank. Again, the format of the KYC is also been mentioned with it's also given in the master directions. So that specific format has to be used. Letter of debit authorization is basically that amount has been received in your bank account. So that also you have to show it. That also you have to give it to the RBI that much amount has been received by the Indian entity of the share subscribed by the non-resident. If there's an approval of FIBB, then yes, that requirement is there. Form FC, which we have described, which we have discussed in detail. So I will just go fast with respect to the same. The important documents are basically your statutory certificate, your valuation reports, your share purchase, any agreement, the underlying document, the board resolutions. You have to check whether 400% your limit of 400% is there or not. If it's in equity share, the fair valuation, whether it's as per the fair value or not. If the investment is whether the investment is within in any country which is prohibited by the FATF, whether share certificates of previous remittance, whether previous compliances have been complied with or not. If investment is exceeding 5 million USD, okay, that's a valuation report. That is okay. Then there's a form DI. Form DI basically deals with downstream investments. So what is downstream investment? Basically, if there's an Indian entity who has received FDI, now is making further investment in in Indian entity. So this second Indian entity, ultimate Indian entity, is receiving an indirect FDI. So a form DI has to be filed by the entity who is making this downstream investment. It has to be filed within 30 days from the allotment of equity instruments, and it again has to be filed at the firm's portal. So who's required to file? The Indian entity who has this FDI and who's making this downstream investment. The documents which have to be attached are the valuation report of the investee, because again it is matter of equity shares being involved, so the valuation report of the investee is required. When FDI is involved, a CA company secretary declaration will be required. Then again, a declaration in Annexure 5 format, there's a declaration which is required. Then, as I mentioned earlier also, with respect to Form DI, not only do you have to file the form on the firm's portal, but you also have to file it on the DPIIT portal, which is the government's portal, and you have to file that form over there also. So you have to ensure, see, there's a limit of 30 days. So once this downstream investment has been done, you have to make sure these two forms are filed. And again, both the places you will require some login credentials, and you may have to make so logins, and that may take some time. So always try to start the work as soon as possible, or at least while transaction is being done, at least try to create the login beforehand. Form LLP1 is basically if the LLP is receiving FDIs, if it is receiving capital contribution from a foreign investor, Form LLP1 has to be filed. Who has to file? The LLP who is receiving that fund contribution. It has to be filed within 30 days of receipt of the consideration. The important documents to be attached is valuation report of the Form LLP. Now, this is also a task because valuation report of equity shares is more simpler than valuation report of Form LLP of an LLP, because valuing an LLP becomes a little bit difficult with respect to the rights of the partners, because they may not be fixed. See, the partners may have different ratio with respect to the capital rights and different ratio with respect to the profit rights. So it becomes a little critical. So as an auditor or as a consultant, you have to understand what will be the valuation and whether it is correct if you're providing the valuation document. Even if you're checking the valuation document, you have to take care of that. Then the LLP deed has to be attached. The consent letters have to be attached between the resident and non-resident. There are some declarations which are there in the standard formats that have to be there. See, and Form LLP1, Form LLP2, when you look into the rules and regulation with respect to the same, they have mentioned certain, they have disclosed whether certain type of transactions are repatriable and certain type of FDIs are non-repatriable. So you have to ensure whether this foreign investment is within the repatriable limits or non-repatriable limits, and reporting has to be done accordingly. Form LLP2 is disinvestment or transfer of capital contribution back to the non-resident by the LLP. It has to be filed within 60 days from the date of the money being transferred. Again, it has to be filed in the firm's portal. It has to be filed by the Indian LLP. The important documents to be attached is the LLP deed, the valuation reports, the consent letters, the standard declarations, tax compliance, because remittance being outward, there's a disinvestment being done, but tax compliance plays a key role. Again, as I said, when you're doing a repatriation, when the LLP is repatriating the amount back, check whether this amount which was bought in, the FDI bought in, whether it was as per the Annexure 5 or Annexure 4 of the Master Direction. See, there's a Master Direction for investment in India. If you look at this master direction, they have mentioned an Annexure 4 and Annexure 5, where they have given details of FDIs which can be got on repatriable basis and FDIs which can be got on non-repatriable basis. So if it is in the non-repatriable basis, you will not be able to transfer back that money. So you have to make sure it is the FDI which was received was as per the repatriable basis. Normally, when you do the Form LP1, you get the RBI certificate also. It is mentioned over there also. This is this investment which has been done in the LLP is on the repatriable basis, because that is all depend on your filing. So when you're filing your Form LP1, make sure you put in the correct tabs, because that will be mentioned on your certificates, which will be mentioned on your RBI acknowledgements, that whether this investment was a repatriable one or a non-repatriable one. And again, while making the Form LP2, you should go and check that, and you should have that on record. Now, if it is on a repatriable basis, please ensure the amount is directly repatriated to the NRE account and not the NRO account. Because if you see the NRE account rules and NRO account rules, see, for transferring this amount back from the NRO to NRE is going to be a big problem, which we face in one entity of ours. So the RBI is allowing you to remit the money back directly to the NRE account of the non-resident. So make sure it has been transferred to the NRE account to the non-resident. Because if it comes to the NRO, then again transferring back from the NRO NRE, you have to go to the specific provision whether it will be allowed or not. The form APR we've already discussed. The important documents which are required is the audited accounts of the foreign entity if the control is exercised by the Indian entity, board decision of the Indian entity, adopting the accounts of the foreign entity. Basically, APR will contain details of your foreign entity share capital, net worth, profit and loss. So this APR is to be signed by the directors as well as the statutory auditor. Then there's a form FLA. The form FLA is basically for any Indian entity who has either received FDI or has given ODI. And at the time, and this FDI or ODI persists, form FLA will have to be filed. Now, in this form FLA, this form FLA is filed on a separate portal. It's on a Flare portal and not on the firm's portal. So this is on a Flare portal. There's no attachment which has to be done on this for filing this form FLA. Currently, the due date is 15th of July. So for March 25, we are right now in April. The 15th of July will be the due date for form FLA. So you should all be geared up for that. Already the logins, the registration with respect to the portal should be done beforehand. Basic information which you require is, see, there are 4 to 5 basic information which is required. You will have to ask the Indian entity to prepare a provisional balance sheet of the Indian entity and the foreign entity and basic documents and base because you will just have to mention the basic figures. For example, the paid up share capital you have to report. You have to report the reserve and surplus, the net worth, the PBT, the profit after tax, domestic and export sales, and the domestic and export purchase, import purchases. Basically, FLA is what they want. The RBI and the government basically they want to know the amount of FDIs or ODIs currently being done by the Indian entities and what are the transaction levels which have been done by these Indian entities. So this is only for the reporting purposes. That's what they want the information for that. Again, they also want the information of number of employees on the payroll of the Indian entity who received the FDI or is given the ODI, the amount of the foreign receivables and payables. So, so you have to give disclosure about your foreign debtors, your foreign loan or creditor balances that has been disclosed, your percentage shareholding in the Indian entity. Suppose if there's an FDI, if the percentage, how much percentage shareholding has been done by the foreign entity, and if done an ODI, how much percentage shareholding the Indian entity has in the foreign entity, that you have to disclose. Then there's a Softex form. Now this Softex form is basically a software export declaration form. This is to be done basically for any entities who are providing software and software related export services. Basically, they want to monitor and regulate the foreign exchange coming in through these software exports. See, basically, what is happening is when you're providing software export services, there is no output of goods being done and foreign money is being received in India. So they just want to have a proof and a documentation whether this money which is being received, which is being coming to the Indian entity, it is as per the right source and it is for the business purposes itself. So that's what they want to check. So the due date is 30th day of the following month from the date of the export invoice. So for April, it will be the 30th. For invoices for your month of April, the due date will be the 30th of May. For this, there's a separate department, a software and economic zone of India, and you have to file the software form on the HTPI online .htpi.in. There's a portal where you have to file these software forms. So this is very important. Even if you're doing an audit of any Indian entity who is providing software export services, who is providing IT related services, you have to ensure that the software forms are being filed in time or not. The important documents for the Softex are your export invoice, the copy of your FIRC. They also want the contract between the Indian exporter and the foreign service receiver. They also want the invoice of the internet service provider of the Indian entity. Why? Because it gives up, see, an Indian entity who is providing software services will consume a lot of internet. So that's why they require the invoice of the internet service provider of the Indian exporter. This software form is generated on the portal and it has to be digitally signed by the management and it has to be uploaded back. Again, you also have to give the details of the number of employees employed by the Indian entity. Now, there are various forms which have to be filed. One is the SERF form, which is the service export reporting form. Basically, you just have to report how much the aggregate export sale you have done. So this has to be disclosed in a software. It has to be downloaded, signed by the exporter, and submitted. Then there's the monthly performance report. Now, as soon as you file this SRF, as soon as you file this form SERF, this form MPR will be generated. It will calculate the export sale which you have disclosed in the software form in that financial year, and it will compare with the exported turnover which you have disclosed on the HTPI portal before filing the software forms. See what has happened. What happens is when you're in the beginning of the year, you have to file with the software form and your expected export turnover for the year. Now, when you're filing a monthly SERF forms, it will calculate how much export turnover you have done in comparison to your aggregate export turnover which you are expecting. Now, why they want this is because there are some charges which you have to pay to the Softex, and the charges is calculated on the amount of aggregate export you're going to do. So, if your export is going to exceed the amount you have mentioned while paying the charges, you may have to pay that extra charges for the Softex. Then Softex also has an annual performance report which has to be filed annually. Now, this has to be signed by the chartered accountant. So again, here we can help the client with certification. 15 CCB, again, is it with respect to Income Tax Act. However, it requires the chartered accountant to study the DTAs, double taxation avoidance agreement between each entities. It is also required when you're doing a FCTRS transactions. If a sale is being done or from LLP to, so your 15 CB has to be certified by the chartered accountant. The tax has to be certified. You may require a lower tax deduction certificates from the income tax. So that all we can help the clients. So, as I discussed earlier, there are two portals of FEMA. One is the Flare portal and one is the Firms portal. Flare is for the FLA forms, and Firms is for basically all the other forms. Your Form FCTRS, your Form FCGPR, your Form LLP1, Form LLP2. So these all are to be filed on the Firms portal. Forms to be filed in a hard copy is Form ODI, which is respect to direct investment, overseas direct investment, and the Form APR, with respect to the Form ODI. Now, when you go to the firms portal, there are two types of logins you have to make. One is an entity user login and one is a business user login. So you need to understand which login you have to make, and you have to create both the logins. So entity user is basically the person authorized by the entity. So basically that entity who has to register has to have an entity login. All these compliances, all these form filing has to be done by an authorized person. So the company will authorize a person by a board resolution, it will authorize, or by a letter of authority, it will authorize maybe its director or any person who is responsible for filing this form, and that authorized person will get himself registered as an entity user. So basically, the entity who has received the foreign investment, or who is required to provide details of this foreign investment, including indirect foreign investment, he has to prepare the entity user login. Once you register for this entity user login, you have to give the total capital of the company, pre and post shareholding. See, now one entity can have only one entity user login. Now, when you're making these logins, be rest assured, understand the email IDs or your mobile numbers which you're putting in. Because if any change you want to make, see, all this your login and your communication will be done through the email ID. So make uh, in your entity level. So consult. I mean, when you're consulting your client, try to make them understand, try to help them to put that email ID which will be available to them even after a specific person leaves, or a person on some post leaves. Because to create another login, a lot of communication has to be done through the help desk. It is not very easy, it is not directly easily which you can do it. So while preparing the login only, make sure you put that email ID which will be available in future also. If not, you have to go to the contact us and you have to go to the firm's help desk. See, with respect to my experience with the firm help desk, it is good. They respond back very quickly. But then again, you're having some interdependency. So why to keep that interdependency? Now, then there is a business user. The business user of the order is who will create a see. Now, entity user and business user can be the same also. Now, business user is basically the Indian entity who is responsible for filing the form and reporting to the RBI. So business user one register has to select the SIN of the entity whose investment is being transferred. So entity user is basically the entity whose shares are being transferred or who is receiving the FDI, and business user who is the one who is responsible for filing the form. So they may be the same or they may not be the same. So these are the various steps which I have mentioned of how the entity user and business user logins have to be created. You can refer to my PPT and for the steps of the same. I'll just mention some examples. So, for example, if you're filing a form FCTRS, an Indian company is selling the shares of an Indian company B to a foreign company. Okay. So, uh, who will create the entity user and who will create the business user? So, entity user will be created by the B company whose shares are being transferred, and business user will be created by the person who is responsible for filing this form. We all read who's responsible for finding the form FCTRS, the transferor or transferee resident in India, the a person who is resident in India, either the transferor or the transferee who is a resident in India. So he has to file the he is responsible for filing the form. So he will file the he will create the business user login, and entity user login will be created by the the company whose shares are being transferred. And then, and once your business user, when you prepare a business user, you will link it to the entity user. You will enter the SIN of the entity user and it will get linked, and the transaction will get linked over there. Now it is an LLP. If LLP is receiving foreign investment, now there's no transfer of shares being done, and LLP is receiving foreign investment. So both the entity user and the business user will be created by the LLP itself. Again, FCGPR, an Indian company is receiving of FDI for issue of shares. So uh, the company whose shares are being transferred is the company itself, and who's required to report to the FCGPR, the company itself. So both the logins will be created by the Indian company A itself. So for this registration, you require the authority letter because, again, as I said, the authorized person has to get himself registered. So the company has to provide the authority letter to the authorized person to get himself registered on the portals as an entity user or a business user. Then there has to be a verification letter. The SIN of the company has to be there. The PAN of the authorized representative also has to be there on the letter. Email ID again is very must because all the OTPs will come over here. So if you want to change this email ID, you have to go to the contact help desk information and you have to get it changed. But whenever you're logging into the Flare portal, you will require that OTP and that will be a must. So as I said, OTP will be required each time you log in. So make sure you you put an appropriate email ID for registering with them. Thank you. I'll end my session with the same. Any questions? I can answer the same.
Thank you so much for the lovely session, sir.
Thank you, ma'am.
There are few questions that needs to be asked to you.
Yes, ma'am.
Yes, there is one question from CA Anshul Agrawal. He's saying whether there is any violation of FEMA or FCA provisions where a charitable trust situated in India asks their foreign donors to make payments to their Indian suppliers directly against the goods supplied by them for their charitable activities, as the trust does not have FCRA certificate. In simple words, whether an Indian trust can receive goods in charity from Indian supplier whose payment will be made by foreign donors.
See, whenever you're complexing the transaction, because normally in FEMA, when you say person A has to receive money from person B, it has to be done that way. If it is on one behalf of another, it comes under complications and it have to be checked. So according to me, it may not be allowed. According to me.
There is another question, sir. It says there is an allegation of a major business group diverting funds abroad in the form of ODI and using those investments to acquire shares of the Indian investing entity for enhancing their indirect control of the promoter group. What are the precautions to be taken by CA who may have to advise audit issue certificate to Indian entities who may I tend to use who may intend to use ODI for purposes in violation of Government of India RBI guidelines?
See, any entity who is not complying with the ODI rules and regulations, so there are strict penalties because the money is going outside India, and there will be a notice from the RBI. There will be a notice. There will be various penalties being will be prescribed. So you have to advise the client. You have to make them understand the penalties and the problems that they may face. See, once you come under scrutiny and once you've been there's some delay in regulation, you will not be able to make another ODI. So you will not be able to make another ODI transaction also. So that you have to advise your client.
Can we
And for
put it
statutory order, you
somewhere
can.
in reports also?
Sorry, ma'am.
Can we put it somewhere in reports also?
In your report, see, if suppose you're a statutory auditor, first of all, you'll have to prepare this. You have to give this ODI certificate. So if you know ki if it is not, if it is violating any provision of the ODI, you will not be able to give the certificate. So you will not be able to make this ODI. Either have to change the statutory auditor if you're not making the certificate. So that is the thing you have to do.
Okay.
And
So
if
there is another question from CA Poonam Khemchandani. If a freelancer is providing services on Upwork or Fiverr, he is not providing software related service, then soft tax is applicable.
what type of service is he providing?
Sir, he it's there only freelancer services. It's written here.
See, normal export services, if you're providing any normal export services, that is okay. But if it is with respect to software or with respect to software or export of software, IT related, then you have to report to the soft tax. Otherwise,
Okay.
I'm doing
In
normal
other
consultancy,
cases,
I can give.
okay. In other cases, it is not required.
If you're giving a software related consultancy, then it will be required. If you're
Okay.
giving a technological software consultancy, then it will be required.
Okay. There's another question from CA Bhupinder Singh Hire. He says, can a resident individual invest in a company registered overseas if the sole objective of that company is to hold share in other companies? Shall that company come under financial services as that company shall have more than 50% of its assets as shares, financial assets?
Yes.
And can a non-financial company in India invest in a foreign company mentioned in point 1 without achieving 3 years of net profit? Okay.
Yeah. So, one point I missed out in my ODI. Thank you for asking this question. Because when you're making ODI, you have to make sure that the foreign entity is engaged in bona fide business activity. That is a must. So when you're making a ODI, you have to ensure that a foreign entity has a bona fide business activity. And if it just wants to have investment in shares, it will come under it may come under financing guidelines, and that
Hmm.
3 years profit will be required. So basically, it has to be a bona fide business activity. You have to see what sector it is. You may ask for the MOA or AOA of the foreign entity, and try to understand what sector it is involved in. If it is just for investment in shares, then it will not be permitted according to me.
Okay. There's another question says any format of audit report for foreign entities WOS whose accounts are not required as per host company regulation. This is from CAMM Narang.
See, format has to be done. Format has to be as per the formats prescribed by the rules or regulation of the foreign country. It cannot be as per the formats of the Indian of the as per India, as per the audit reports prescribed by the Companies Act. So it has to be as per the formats prescribed by for the relevant country for the relevant country. It has to be as per them only. Whatever relevant format is prevalent over there. For example, if it's a foreign entity in US, so it has to has the audit report with respect to that formats which are required over there.
Okay. And the next question is from Syed Zia Abbas Rizvi. An LLP took capital from a foreign partner in a regular account 2 years ago. No filing has been done so far. What should be done?
You'll have to regularize the same. Basically, 3 years. See, you may have to pay some LSF fees. So you should contact the AD bank and try to file the forms as fast as possible and pay the LSF fees. Up to 3 years, you can for 3 years of regularization, you can pay the LSF fees and get away with it. I mean,
Combined.
you can close the case.
Okay. There is another question. The DSF method for allotment of equity shares to new overseas investor by a private limited company typically results in higher valuations compared to methods like NAV due to its emphasis on projected cash flows. It also incorporates speculative income estimates. In such cases, would the RBI mandate the use of DCF valuation method over NAV? It is from Rajkumar Khandi.
Yes. No, as per the rules and regulation they have prescribed, it has to be at the arm's length price as per the best internationally accepted practices. So they have not defined whether it has to be DCF or whether it has to be net worth. They have not mentioned it. As an auditor, you should we have to take a call. First of all, the valuation report has to be first we have to understand who has signed the valuation report, whether it has been signed by a chartered accountant or a merchant bank who is capable of doing this valuation work. So we all know there's a standard of auditing where we have to check the work we have to depend on the work of another auditor or work of another entity. So there you have to first check whether the person who has given this valuation report, whether it is proper standard account firm or a merchant banker who can give this level of valuation report. And you can just go through the and you can make an estimate of yourself also whether this is the best practice available. But if you understand that the valuation report has been done by a chartered accountant or a merchant banker who is in practice since a long period, and who is also quite well known with respect to the valuations, then you may place some reliance on the same. However, you may bring a judgment into play, but it is not restricted by the RBI. You have to bring your judgment into play, and you have to understand whether it has been prepared by a proper responsible person.
Okay. The next question is from Syed Zia Abbas Rizvi again. It says, if a company is giving its services by preparing and testing the investment strategy based on data from stock exchange on NASDAQ, no software or code is sent, whether any violation as it is not a software.
Can you repeat, ma'am? I didn't understand the question. What exactly service is he providing?
Just a second, sir. The company is giving its services by preparing and testing the investment strategies based on data from the stock exchange on NASDAQ.
Mm-hmm.
No software or code is sent, whether any violation as it is not a software.
No, I don't think that is a Softex export.
Okay.
It's consultancy which being given. For example, as a chartered accountant, also I can give some consultancy. I can give some professional consultancy to a foreign editor. That is allowed. Because if you see your current account transaction rules, your day-to-day transactions are all allowed in the current account transactions. And if you see your current account rules, first of all, when you're looking at a transaction, you have to see whether it is a current account transaction or capital account transaction. Current account transaction normally are all allowed unless restricted. So this is under the current account rules, and it is not with respect to Softex, and it's not with respect to sale of any export services or technical services with respect to the software. So that should not be a problem.
Okay.
But that money should be received. Your money should be received in India, and that you should have the FIRC. That is very important. When you are making
Okay.
a bill, the FIRC should be there, and that should be received. There's a time period also for receiving the money, so that has to be checked.
Let me check if there are any further questions. So there are few questions that few people are asking whether we will get PPT and
Yes,
what should be the average fees that should be charged for ODI filings for startups.
yes. See, for ODI, we have to understand if we are also the statutory auditor and if we are also signing the statutory audit certificate. So there is a lot of risk also involved, and there is a lot of documentation will be involved, a lot of quality checks which will be involved. So you have to take that into account, and you'll have to educate your consultant, or you have to educate your client with respect to the intricacies which are involved over here. And there are so many rules and regulations which you have to follow, and you cannot default in these rules and regulations. They all clients, they may negotiate for fees with the statutory audits or anything, but with respect to FEMA work, when normally they know, they do not want to make any non-compliances, and they don't want any attract any penalties with respect to FEMA. So they normally, I've seen clients are very strict about that. They do not mind paying a little bit more to the consultant if they are ensured that the documentation and the work and the filings will be perfect. So you should value these. You should value these services. You should, because see, you'll have to read through the rules and regulations when you're certifying this statutory certificate. So you'll have to value your time. You'll have to give value to your certificate, because you are certifying something true and correct, and you have to explain the same to your consult your management, and you should code accordingly.
Okay. I believe every question and answers are over. So, thank you so much for delivering such an exceptional presentation on FEMA background, ODI, and forms filing at the 95th Know Your Law series webinar organized by Committee on Commercial Law, Economic Advisory, and NPO Cooperatives on this day. Your expertise and clear insights greatly enriched our understanding of this critical topic, making the session both informative and engaging. The two CPRs were well spent, and your contribution is deeply appreciated by all our attendees. We look forward to benefiting from your knowledge in future events also. A heartfelt thank you to our speaker, CA Amar Goawalaji, On behalf of Committee on Commercial Law and Economic Advisory and NPO Cooperative of Institute of Chartered Accountants of India. Thank you so much, sir.
Thank you, ma'am. Thank you, ma'am, and thank you, the committee. Thank you.
Thank you.
Thank you.